So no, this is great. We spent a lot of time today discussing what the SEC thinks about this space. And this panel, I think, is going to be very interesting to everyone because we're now going to talk more about what another regulatory body is thinking about this space, and that is the IRS. So with that, let me first have you guys each introduce yourselves, and then we'll just jump right into questions.
Sure.
Start with Tom.
Good afternoon, everyone. My name's Tom Cardinale. I'm a corporate tax partner at Eisner Amper Accountants and Advisors. Deal with corporate tax compliance for multinational businesses, foreign, domestic, multi-state. And for the last year and a half, I've been dealing a lot with tech, fintech, and blockchain companies, help advise them on general entity structuring, general revenue recognition issues, tax issues, getting them set up. A lot of it is pretty much new to all of us, but the IRS has been kicking up their guidance on it. So our own firm has a group for the blockchain and cryptocurrency advising group, and I'm one of the tax leaders of that group, and things have been very exciting. So happy to be here and offer my insight.
Great. Thanks, Tom.
Great. Good afternoon, everyone. My name is James Jones. My background is former Merrill Lynch, Wells Fargo, on the retail wealth management side. For the last approximate 7-8 years, I launched the IRA Exchange, which is the first marketplace that brings together capital raisers in terms of investment sponsors, issuers under Reg A plus Reg D, along with self-directed IRA investors, as well as registered investment advisors.
Great. So, Tom, let's start with you, and we could jump right into really how the IRS is viewing cryptocurrencies.
So the evolution of the IRS, what they think of cryptocurrencies, has been a turbulent one. They first came out in 2014, and back then the overall market cap of crypto is in the $6 to $10 billion range by IRS standards. That's small potatoes. So they came out with IRS Notice 2014-21. So 6 years ago already, they passed this, and they essentially, to put it shortly, they consider crypto property. Now, we could all say that, of course it's property. Well, what does that mean? In the tax sense, that's very important, because property can have two differing tax implications for property. Ordinary, which can be taxed at 37% if you're an individual, 20% if you're an investor, capital gains, assuming long-term over a year. So that's what they initially came out with. It was only 2 or 3 pages, and they put it out there, and then from 2014 to, say, 2018, they moved in 2 speeds. Idle and stop. Okay. 2018 comes around and things kicked up again. At the end of last year, actually in December, only a few months ago, they passed a very robust frequently asked questions. You could Google it, go right to frequently asked questions, IRS on crypto. And they really lay it out there. We believe crypto is a virtual currency. If it's tradable like a Bitcoin, they call it convertible virtual currency. But they kind of side with the digital store of value. They put on the frequently asked questions probably 6 or 7 definitions of it. Yeah, store of value, utility, virtual currency. They tend to be in the camp that it's a digital representation of value or a store of value. So that's what they think of it as of today.
Okay, and that's if if people are investing directly into a cryptocurrency like a Bitcoin, or now what about hard forks or airdrops, which we had some discussion of that today?
Yeah, if anyone has been involved in hard forks, which is a protocol change with a blockchain network, probably the most famous one is the Bitcoin Cash hard fork, which was a byproduct of the original Bitcoin hard fork. If back then there was no guidance on that, you would get airdropped a new currency after a hard fork, and people really had to interpret, well, how do I treat this on my tax return? I just got $500 of value in a new currency. Because there was no guidance, you can make a reasonable assumption it was a dividend. And the implication of that on a tax return is dividends are taxed much lower than it would be as ordinary, right? The ordinary rate's 37%. Dividends 20% or 23.8 with the Medicare tax on it. So that's a big spread between tax rates. Now the IRS came out and said, well, guess what? If you get an airdrop of a new currency, it's not a dividend. It's not a capital gain. It's ordinary. They have come right out and said it's ordinary, and you would have to put on your tax return as other income. which is on a new schedule now with the 1040 form, but it's basically taxed at your ordinary rate, which can be as low as 10%, go all the way to 37%, depending on your income.
Well, so this past summer, the IRS had mailed over 10,000 letters to taxpayers that they suspected had crypto holdings that were not reported. How, and I don't know if anyone here has received any of those letters, but
You don't have to raise your hand if you got that letter. That's right.
but how serious should they take it if you have received it?
Yeah, these enforcement letters, if you're following some IRS actions on enforcement of unreported gains, and there's been thousands upon thousands of unreported cases, there was a John Doe case, which was like a universal case against Coinbase Exchange in San Francisco. You're probably all aware of Coinbase. And they were able to pull out of that investors that had over $20,000 of gross volume in trades, and they would check that to their tax returns, saw that nothing was reported, and based on that suspicion, they sent out 3 versions of letters. Two of them are more instructional and a shot across the bow, saying, we think you might have cryptocurrency, but we haven't seen anything in your tax returns. Be sure to put it on your tax returns. You should do this and that. So it's more of an instructional. One of them is definitely a warning, a much more important letter. It's a 6173 letter. They basically, the IRS comes out and says, we know you have had crypto. We know you didn't report it. We want you to sign this penalty of perjury statement. We want you to amend your prior year return. Let us know, or send us all the documents of what you had, and we'll get your account straightened out. So that one is much more serious. And the IRS commissioner even came out and said these are very serious letters. But I would say just that one is more serious, and the other 2 are more instructional.
And this is from, where are they getting the names from? How are they?
Well, this is part of the John Doe case with Coinbase. They were able to release, initially the IRS wanted anyone that was in Coinbase that traded, they wanted everyone's name and their address. They took it to court, and it was like a partial victory for the IRS, where they said, okay, we just want the most heavily traded ones, which was like, I think 13 or 14,000 names out of over 100,000 were selected. They did win that in court to get those.
That's interesting.
Yeah.
So I'm curious here, I don't know if anyone started filing their tax returns for this year, but we spoke the other day, and you made me aware of this. I didn't know this yet, but I thought this was very interesting, that on the new 1040s, there's a new mandatory question.
Mm-hmm. That's right. Has anyone filed their tax return yet? It's kind of early.
Yeah.
Okay, so no one raised their hand. So this one's important. Brand new question on the top of Schedule 1 of your 1040 return, right at the top. And you can easily miss it because you got the heading, all the instructions, go to the website, and right underneath that it says, have you, during the year 2019, acquired, transferred, given, sold, purchased any virtual currency during the year? Yes, a yes or no question. If any of you are familiar with the FBAR, which is a foreign bank account report, it's also one of those mandatory questions on a 1040. That's very important to answer, and now it's got kind of a friend next to it. Now they're putting virtual currency with it. The implication with that is that it's a penalty of perjury. Your tax return, when you're answering questions, that's under penalty of perjury when you sign. It's not so much before that, it was like, well, we trust you. If you have crypto, you're going to report it. Now they're putting the question out there. And I would say, don't gamble. The house always wins in the end. And if you did trade in any currencies, put it in there, even if it was small, immaterial. I think they're using it more for tracking purposes. It's kind of an unknown right now, but just answer it correctly and don't leave it blank either.
Yeah, well, I was going to say, what happens if you leave it blank? I mean, they'll just assume it's a yes?
They would no, they won't assume anything. It would be like almost like an incomplete answer, or I abstain, almost like a politician saying,
Right.
I'm abstaining from voting. It's not good enough. You need to answer it yes or no.
And is this anything, whatever your answer is, leaving it blank, saying yes, or could that trigger an audit?
It's hard to know. I think it's more informational collecting right now.
Okay.
But, because the IRS audit rates of your personal return are at all-time lows. On average, every year, only 1 out of every 200 returns gets selected, so a half of 1%. I can't, due to the lack of resources at the IRS, I don't see that getting jacked up too much because a lot of people are answering yes to that question. But if you answer yes and you're making, if you're high income, let's say you're making $1 million a year and you answer yes to that question, but your capital gains schedule shows no reporting activity, I wouldn't be surprised if you got a letter saying, okay, can you confirm this? You answered yes, but your Schedule D for capital gains and losses is blank. Why? I could see them doing that. That's more akin to a desk audit where they're just kind of doing a feeler out.
So it's interesting because about a year ago, we actually did a podcast together, and we were talking at that time that the conversation was about people failing to report, and at that time, because we were going into, it was looking at the year 2018, for those were the 2018 returns, people were failing to report cryptocurrency losses.
Right.
And so, just curious about that with reporting gains and reporting losses. I mean, I know that, and probably people here who are actively or more actively trading it, there's a challenge in actually trying to figure out what exactly your cost basis is, and this actually goes to talking about some of the tools.
Right.
So how do you see just the reporting and the tracking, and how is that shaping up in the industry?
So I'll speak more on the individual level. I think that's what people are most interested in. But we get often a lot of questions like, how might the reports you get out of some of these exchanges are horrible. You have to almost do your own tracking of basis on all your purchases of crypto. But I can tell you is that the IRS would accept choosing of lots when you're eventually selling. The default is FIFO. Your oldest ones would be sold first, just down the line. But you can do specific identification, just similar to a regular stock if you own it. As long as you identify it and you keep a record of it, if you want to manage your timing and your gains and losses throughout the year, you can select which ones. You can, but you just have to keep good records on it.
And even, these are 24/7 markets, so it's not like, it's not like you go and you could check out a stock and see the close on that day.
Yep, that's
So
true. Yep.
you have to really,
Yes, you do.
to try, and who knows how much it could swing in that day too. That could be significant. So I have one last question for you, Tom, and then we'll move over to Jim, because I'm not leaving you out here. There's a method to the madness. But Tom, last month, there were two of our Congress people had introduced the Virtual Currency Tax Fairness Act. Now, we all know it's a bipartisan bill. We all know the climate now. It'd probably be difficult in the House to get anything done. So I don't, we could talk about maybe the likelihood of passing, but talk a little bit, because I thought it was very interesting in terms of in terms of kind of alleviating some of the capital gains tax if you're using your cryptocurrency as a utility, and using it to actually make purchases under a very small threshold, like $200. So
Right. So the foundation of that bill that's in Congress right now, I forget, the Crypto Fairness Act or something like that, is basically a tack onto an existing law already out there. It's under Section 988. If you take a trip to, say, Italy or the Eurozone, one of your first steps is going to be buying euros, right? Now, let's say you go there for a couple weeks, and over that time, the euro plummets and the U.S. dollar gets stronger. You have basically more purchasing power. Technically, if you're purchasing something there of high value, you would have a gain just in that time. You were, because of price fluctuations. So 988 was passed to say, well, if you're buying something personally, it's a personal transaction, and each transaction is under $200 of value, or the gain on it, you're exempt and you don't have to report it. So that was only on foreign currency transactions, so to speak, but it specifically left out, crypto. And when crypto was coming out, they said, well, we're not going to include that. So all this is doing is trying to insert that with the foreign currency pool, saying if you do an individual transaction, you buy I know Starbucks, you buy a latte with Bitcoin, you don't want to be reporting gains and losses in every coffee you buy.
Right.
It doesn't make sense. So the practicality of it is there. The odds it would get passed this year, I think, are remote, only because it's a hyper-partisan atmosphere and because it's really not mainstream yet. This is like the birth of the mainstream people here, but it's so limited right now.
And granted that it's probably not going to happen for a while, but it is. They said that the threshold was $200. So theoretically,
Per transaction, 200.
right. So theoretically, let's say I have $10,000 worth of Bitcoin gains. Now, can I slowly, every
No.
day, $200 here,
No.
$200?
Because that's an investing/business transaction. It's
Okay.
not considered a personal transaction. So
Okay.
that would be an easy loophole. You sell $199 a gain a day and you're all
Right.
done, but no.
Right. So it's interesting because, we talked with Tom really focusing on the tax implications. Now we're going to change gears a little bit and talk to Jim about some of the opportunities to invest in the space with tax deferred. So, Jim, I want to kind of, as switching gears and talking to you as a retirement expert, and trying to find ways to defer taxes through using retirement dollars. Can you discuss the current state of self-directed IRA investing in this space of digital assets?
Yeah.
Is it here?
Yeah, so really, I can answer that in 2 words. One is early, right?
Yeah.
Surprise, surprise. Excuse me. And the other is bifurcated, which I'm going to explain a little bit of that in the next question. But just out of interest, has anybody bought any crypto in a retirement account? Anybody? Okay.
No, it's interesting.
So, yeah, that's about stays with the industry standards, which the reason why Tom is so important is about 99% of transactions in crypto is in tax cashable accounts. And so for those people that are raising capital, if they want to know where the money is, well, the money is in the retirement accounts. And we're going to talk about those numbers in a little bit. But just for the benefit of everybody, a self-directed IRA is, in terms of IRS code publication 590, it works the same as any other IRA. The one difference is a code called 4975, which basically allows your IRA to invest in thousands of different assets. Just think of them as privately owned. So your Schwab, your Fidelity IRA invests in publicly traded securities, stocks, bonds, mutual funds, and ETFs, right? Well, there's this whole other world where you can invest in real estate, precious metals, private equity, private debt, herds of cattle. Again, there are literally thousands of different asset categories. So that's what a self-directed IRA is, and obviously one of the newest exciting asset classes to come into this space is crypto. But just as there's issues to be careful of on the taxable side, even more so on the retirement side.
Yeah, and I want to talk about that a little bit because, as you said, I mean, even just from this room, really 100% in this room, everybody is invested in cash accounts. So could you talk a little bit just about the infrastructure of the self-directed IRA? I mean, and you and I know we've had these conversations ad nauseum over the years. Talking about just the infrastructure and the backbone that is such antiquated technology. So how could they, and it works, if you're investing in, $200,000 piece of real estate, because of the cost to hold that, to custody that piece of property in the self-directed IRA. But when someone's going investing, $50, worth of Bitcoin or Ether, the economics aren't there. You're not going to pay, $200 to hold a $50 asset. So what are you seeing there? How is that developing?
So when I talked about bifurcation, there's really what we would call the traditional self-directed IRA custodians. Those are basically non-fiduciary trust companies. They're just a passive entity that will keep your private asset in compliance with the IRS, right? So the folks that are in the space, 30, 40 plus years of experience, know the state banking charter laws related to the IRS inside and out, very compliance and regulatory driven. Technology, not so much, okay? They are currently operating on 40-year-old legacy IT systems, which really means lots and lots of paperwork to sign, which, as we get into the integration into crypto and blockchain, there is no integration currently. So that's the majority of the market. What we saw is some of the crypto platforms and providers want to get into that and tap that space. They started to partner with some of the existing custodians. In fact, one had acquired one of the majors, and 3 months later, they dashed the deal because they realized how archaic the IT infrastructure, accounting, administration technology was. And so they launched their own trust companies. not so hard to do if you go to friendly states like South Dakota. But here's the problem. Yes, they have the technology, but boy, do they not have the compliance. So without getting too far in the weeds with it, a prohibited transaction is when you have a purchase of a security where there's an issue with the IRS code that follows that. So there have been, on some of those platforms I've read about, people have purchased in cash accounts, did trading, and then took the proceeds and put those into an IRA, which is either overfunding or improperly funding an IRA. Some of those platforms themselves are doing things like promoting and soliciting. I get an email almost every day from one provider out there that's actually forecasting the crypto market in your retirement account. I mean, that is just, wow. The SEC hasn't seen that yet, and somehow the IRS has not. We talked about reporting. There is reporting every year. It's called a Form 5498, where you have to let the IRS know what you have in your self-directed IRA. And a couple of these new crypto platforms offering retirement accounts are not submitting 5498s.
So what's the overall retirement market in the United States right now, just to get a big picture?
So amazing numbers. There are currently $9.2 trillion in IRAs, which over the last 2 years has now surpassed the 401k market of $6.8 trillion. So everybody thinks, oh my God, the 401k. No, the IRAs are larger, and part of that is because you have over $500 billion in baby boom retirement money rolling over from 401ks to IRAs. So once again, for the capital raisers, where's the money? The money is in IRAs and in all this fresh boomer retirement money moving over. Of this, to give you a perspective, of self-directed IRAs, it's about 1%. So of the 50 million IRAs worth $9.2 trillion, there's about 500,000 to less than a million self-directed IRA accounts worth about 150 billion.
So what we're really talking about here, and we talked a lot earlier about asset tokenization and sort of all of these new investment opportunities for retail investors. I mean, you're talking, once we move towards a place where the technology is compatible and workable, and we're able to actually, I mean, that's an incredible opportunity. I mean, you're talking about trillions of dollar opportunity to attract retirement dollars to this place, to this space. Do you foresee that happening?
So when we look at the newer, if you will, asset classes of the last several years, crowdfunding, right, under Reg A plus and Reg D, whether it's real estate or private equity or private debt marketplace lending, we have seen that participation go from about the same 1% to, I had a lunch with a firm I'm working with, a venture capital firm that has embraced self-directed IRAs. And in 1 year, 30% of their business is now coming from self-directed IRAs.
Wow.
So, and again, once again, to put that number in perspective, for every $1 there is in brokerage cash accounts, $20 in retirement accounts. So.
And it's interesting because this market, too, is a market of hodlers, people that are holding. So it's not like there are a lot of, active trade. I mean, there are, but I mean, it's a big holding market. So it seems like it would be a perfect product for a retirement account.
So for any capital raise, obviously the operative word is stickiness, right?
Yeah.
And so the behavior of retirement accounts over stocks, bonds, mutual funds, ETFs is longer term. So that once again is money that people look at like they have left pocket is fast money and back pocket is slow money, and that tends to be that.
So, and I think this is interesting, too. We alluded to that when, Tom, you were talking about the new federal bill, which who knows will be passed or not. But, we do have to address the fact that these are new asset classes that have, a component to it that appreciates like an investment, but a component to it that's also a utility that you could purchase goods and services. So, we talk about an IRA account, and I know especially for a self-directed IRA, you could invest in these alternative type of products as long as you're not actually using them.
Yes.
So could you talk a little bit about, and you had mentioned something about like a checkbook IRA.
Sure.
So how would that work? How could someone, and I think it's an interesting discussion, I haven't really heard anyone really talking about it in the space, but talk about that, because I'd be curious to know how, that could be incorporated sort of into the conversation.
So here comes a next potential crisis or problem if not handled directly by the custodians. So once again, let's think about our Fidelity IRA. We buy an ETF at $10, it goes to $20, we sell it. Those cap gains go where? Right back into your IRA, right? Not into your pocket. That would be a taxable distribution out of your retirement account. You don't get personal benefit. Your IRA gets the benefit of that cap gain. Or if it spins off a dividend, your IRA gets the benefit of that, okay? So please, or let me just take it one example farther with the self-directed IRA. So you can go out and buy a beautiful vacation condominium in Florida, let's say, and you can fix and flip it, you can invest it, you can have a long-term hold on it as an investment property, you can lease it out, rent it out, Airbnb, but you cannot personally have a direct or indirect benefit, meaning you cannot go personally stay there, nor can your parents or grandparents or children or grandchildren, all right? So there's a kind of a lineal descendancy there that you cannot have benefit. So Dara, to answer your question, what becomes the operative word here is who gets the benefit of this token. So not trying to be a crypto attorney here, looking at it more from Department of Labor and IRS. If the IRA will get the benefit of that security through capital appreciation or dividend interest, that will go back into the IRA. The benefit is directly to the IRA. If it's some type of utility token that at some point is going to be exchanged for goods or services that me or you, the IRA holder, would get the benefit of, well, then that would be a prohibitive transaction because the benefit, direct or indirect, goes to you and not the IRA. So again, that's the operative word. So penalties in that situation, if it's less than a year and you prove that, boy, you just really had no idea about this, and you look to correct it, they would probably give you a distribution penalty on that portion. Early distribution and taxed at ordinary income. If you went as far as if the IRS proved that you knew what you were doing and you did that for multiple years in a row, let's say with utility tokens and you were converting it and buying all kinds of personal stuff, the IRS could and has just seized your entire retirement account.
Wow. So is this something that you think that needs to be changed legislatively? Like, I mean, is this something that requires the industry to lobby and start that conversation? Because, I mean, they want to encourage, we want to encourage people saving for retirement, and this is a new asset class that's probably going to be very attractive. I mean, we're already seeing millennials want to own Bitcoin and cryptocurrencies more than they want to own treasuries. So
in my humble opinion, I don't see the IRS changing their code on getting a benefit from your retirement account. So I think where the responsibility is going to lie, and go back to kind of where, as we've seen in so many other spaces, where the traditional incumbents are going to eventually meld through acquisition with the new upstart providers where they will have the knowledge of industry compliance and regulation. So it's really going to be upon the crypto platforms and exchanges and custodians that have to make sure that there's no kind of self-dealing with some kind of utility.
It's really interesting to see how it unfolds. If anyone has any questions, it's your opportunity to get in front of the tax and retirement experts. So, yeah.
I like the expression checkbook IRA.
Yes.
Is that what you were talking about?
Okay, so Dara brought that up. I apologize. I forgot to explain that. So very quickly, if you go to a self-directed IRA custodian, their fee model is not like a regular brokerage firm that takes a piece of the transaction, right? Or takes a spread. They make it on annual fees. And so this is changing, but as recently as 3-4 years ago, you could be charged as much as $600-700 a year per asset to custody those. So if you were buying 4 or 5 items, you'd be looking at several $1,000s. So a legal way around that, the IRS will allow what's called a checkbook IRA. What you simply do is you create an LLC, a limited liability corporation. You name your IRA as the sole beneficiary, sole owner of that LLC. I am allowed to be an uncompensated manager of that LLC, okay? And so what I do is I go down to the local bank, I show them my LLC papers, I open up a business checking account in the name of that IRA LLC, and I direct the custodian to send those IRA funds to this business checking account. Now, no more custodian. So if I want to go on the courthouse steps and I want to buy tax liens, in the old days, I'd have to call up my self-directed IRA custodian, and 4 or 5 weeks later, they're buying tax liens that no longer exist, right? So I can stand on the courthouse steps and I can write a check out of my retirement account and buy tax liens. I can go to an auction and buy a foreclosed property, once again on the courthouse steps, and write a check right out of my IRA. If I have a plumber out at my home that I'm doing a fix and flip, I can write the checks right out of my IRA. So it's a way to bypass the custodian. But again, what happens, the problems that people run into, many real estate investors love the idea of writing off everything you possibly can, right? It's kind of part of the idea and the strategy legally, right, what you can. But then they'll go to Florida and they'll put their airline tickets on their self-directed IRA. They'll put their hotel and their nice meal on their self-directed IRA. Prohibited transaction. You're welcome.
Okay.
Okay. Thank you very much.
Thank you.
Thank you, everyone.